You might be wondering how the stock prices are determined, and this has a lot to do with bid and ask prices and its dynamic. In this video, we're going to show you some of the examples and what are the dynamics that's playing behind the curtains. So let's say, for example, if you open up a website, Yahoo Finance, and if you go to Microsoft Corporation ticker symbol, you would find there is a stock price quoted. So now, what does the stock price quoted mean? So this means this is the last transacted price between buyers and sellers. So you can also find that in the charts, and this is where every time you see a chart, then you have to look at the right hand side is highlighted here in green, or depending on what are the setups in your chart. So let's say, for instance, if you open up your trading platform, and if you go to the trade option, okay, this is what you can see. The last transacted price of Microsoft will be 250 and 79. But that doesn't mean if you buy the stocks, you might not buy it at the same price. If you buy that, you would actually buy ending up at a higher price. So if you're a buyer, then you would have to select this column, ask. So because if you're buying, then you're asking for the underlying shares. So if you move your mouse cursor to this section right here, then it will automatically highlight a buy action. So if you're a seller, then you have to go to the bid column. And if you move your mouse cursor to that column, it will automatically display the sell action. So as you can see, the prices are displayed here. If you're a buyer, it is quoted about 250.88. So it is higher than the last done price. And this is because there's a spread that the broker has to make. There's a difference that the broker has to make, including the commissions. That's the revenue streams for providing the brokerage service to a trader or investor. So if you're bidding, then you could actually be selling at, if you're short selling, then you'll be actually selling at a lower price than the last done price. So now let's move on further. So let's say if you look at the bid and ask prices, the prices ladder. So on the left hand side, we know buyers, they always ask, and whenever there's a buyer, you always want to buy at a lower price most of the time. And if you're a seller, you would want to sell at the highest price possible. So now what happens here is that, well, let's look at the last transaction price. Now let's say if you have three sellers right here at the price 17, and then you would have three buyers at the price of 17. So let's say both of them actually settled in the same amount at 17, and that's what we call the last done price or the stock quoted price. So now, for instance, if you have some amount of buyers and sellers in the markets or in this stock, for instance, now the last done price is $20 right here. So, but if you really want to buy the price right now, you would actually have to end up buying around 21. So there's a bid and ask spread right here, which is around $1. All right. If you want to short sell this stock, then you would have to short sell at 19, even though the stock quoted price is around 20. So there's a bid and ask spread again, $1 right here. Okay. So now, let's say you have more buyers and sellers, and when there are more willing buyers and more willing sellers, then there's more liquidity, and when there's more liquidity or volume, then we will actually see a decrease, a narrowing of the bid and ask spread right here. So instead of $1, then it could be reduced to even 50 cents, for instance. All right, in this case, let's say if you're a buyer, if the last quote price is about 20, then you would have been buying around 20.50. And if you have to immediately sell or short sell the stock at a quoted price of 20, you would have been short selling around 19.50. right? So there's a spread of around 50 cents for this instance. Now let's say, what happens if there are not a lot of willing buyers and sellers? That means, let's say for instance, this stock is not so liquid and you have less amount of buyers and sellers in each of the price level. Then what will happen is that the bid and ask spread will become widened. All right, so let's say the last quoted price is 20, and if a buyer wants to buy immediately at the market price, then the buyer would have to end up buying around 22 US dollar per share. So now we can see there's a spread around $2 right here. So if the same goes for the seller, if the seller wants to sell it immediately with the quoted price around 20 US dollar per share, then the seller would have ended up with selling at 18, lower price. All right. So now right here we can see, okay, this is very often applied to penny stocks, which is not so liquid. Most of the time when you have stocks, strong fundamental stocks like Microsoft, Apple, you wouldn't see such a huge spread. So now let's say, for instance, what moves the price? Now a lot of people say it's supply and demand, but it is actually the buyers, it is actually the quantity of buyers and sellers in the market. So let's say, for instance, in this example, what you will likely see in a bullish day is that when there's more buyers and sellers, then after a certain amount of time, the buyers, they waited for a long time, then not all of them will be buying at lower prices. So if they're very impatient, then they will start to buy at higher prices. So let's say for this instance is that if the now you can see that in a bullish day, the buyers are more than the sellers. So once the buyers move up here, then this would probably satisfy only two buyers because there are only two sellers here, and you still have a remaining three buyers right here, and there's still a lot more buyers lining up behind. So now, of course, there are also more sellers waiting at a higher price. So the further it goes, the more sellers you would see. So because sellers, they want to sell at a higher price. And in this case, buyers, when they want to buy at lower price, you would see more buyers will be waiting at lower prices. But when there's more demand than supply, and more people will be wanting this stock, for instance, if it's a strong fundamental stock trading at lower than intrinsic value, then what will happen is that more buyers will want to own this stock. So what happens is that then it keeps driving the stock up. But the thing is that the amount of sellers cancelling out here will not be able to actually satisfy all the buyers. So let's say for this instance, right here, there are two sellers here. You could only sell to two buyers. Then you have remaining three buyers here. So and then here you have one seller. So when there are more buyers asking about at 22, you probably could satisfy one buyer. And if they become impatient, then we'll start moving further up. All right, to buy at market price. So now same goes for a bearish day. So what we expect in a bearish day is that you would have more sellers than buyers. Sure, sellers, they want to sell at the highest price possible. That's why you can see that in the stock price at 25, you see more lining up here. All right, and the same goes for the buyers. And most buyers, they would actually want to buy at very low price. They would want to buy at 15. So now, for instance, in a bearish day, is the sellers. If they're very impatient, what they will do is that they'll start buying at they'll start selling at lower price. All right. So let's say, for instance, if they go down to 19, that's only when they can get satisfied with two buyers canceling out two sellers. Then you have a remaining of 5 sellers right here. So now you have still a lot of sellers in this price ladder. And of course, if they still cannot wait, then this will actually go further down. All right, further down, of course, because there's less buyers, less people want this stock, and more people, they want to unload the stock. You can see that it doesn't even satisfy most of the sellers. And if they become impatient, it keeps going down further. All right. So, all right, so it's pretty straightforward right here. This is how I would like to actually present how the bid and ask dynamics look like. Now, I hope you enjoyed this video and thank you for your time for watching this video. Happy trading and investing. Signing out here, Striker X.